Welcome, everybody. Thank you for joining us today. We're going to talk a lot about down payment programs, what they are, common features, nuances, differences, and the basics that you as real estate agents want or need to know in order to help uncover solutions for new buyers, prospective buyers, in order to help renters consider home ownership and more. Brief introductions. My name is Sean Moss with Down Payment Resource, and I oversee operations and the tracking and monitoring of this DPA data. We also have with us Tracy Shell, our VP of Marketing in the background, as well as Fern White, our account manager. They will be answering questions as we go, so please keep this interactive and use the chat box, enter any questions, comments, success stories, anything you want to share as we go or anything you want to know that we maybe didn't get to. We will leave time at the end for Q&A so we can review those questions. And with that, let's get started. So here's the core of what we're talking about today. Homebuyer programs, down payment assistance, closing cost help. They can be loans, they can be grants. There are tax credits out there and other kinds of homebuyer assistance that can help achieve the down payment faster. They can help cover closing costs at closing. And essentially, and most importantly, they can help buyers, qualified prospective buyers and renters, get into a home or seriously consider home ownership and engage with you to explore home ownership sooner than they may otherwise have thought possible. So that's what we want to do today, is give you the tools, the knowledge, the information that will help you better understand down payment assistance, the volume and diversity of programs available, and how you can begin to talk about these programs and these opportunities and be a solution provider for your clients today, for tomorrow and next quarter and next year's clients and pipeline as well. There are
Hey, Sean, can you share your screen? I'm not seeing your slides right now.
Oh my gosh, I am so sorry.
That's all right.
I thought I did that. Okay, so there we go. Sorry, guys. All right, so let me step back here. So this is what we're talking
All
about.
right, we're good.
Loans, grants, tax credits, and so forth. And so what I want to start with here is just to give you a little insight into what's happening with down payment assistance programs. We saw a survey from Freddie Mac, and the crux of it was what's the usage of DPAs. We've seen data recently from FHA this year suggesting a similar trend, but it looks like the usage of down payment assistance programs is up by a factor of 2 over the last 6, 7, 8 years. So, and this doesn't even include recent data, but recent data from FHA suggests that this year, 2019 year to date, as of last month, I believe, usage of DPAs with FHA loans is on the rise. So, there's demand for these programs. There's demand for a solution to help with one of, if not the biggest obstacles to home ownership, and that's the down payment. And those solutions are out there. There are 2,500 programs across the country. We track all of them. We're going to see more about that in a moment. But usage and awareness of these programs is on the rise. So we want to help you become one of those that is not necessarily an expert. That's not required of you, but capable of uncovering these solutions and confident speaking about them with buyers. On that note, I actually want to do a poll here. We want to keep this interactive, so fire away with your questions, but also tell us how, we'll start with this one. How often do you work with a first-time home buyer? Do you work exclusively with first-time home buyers? And by the way, you can click your answer right on the screen. Do you work exclusively with first-time home buyers? So are you marketing directly to them? Is that where your marketing budget goes? Are you working frequently with them? So maybe you're new to the business. Maybe you've carved out a niche working with DPAs, first-time home buyers, but occasionally do some other business as well. Or is this just on a referral basis? Or maybe you avoid them altogether. And what we want to do is just get a feel for our audience, but also get a feel for the volume of first-time home buyers you're dealing with so we can cater this presentation to you. So looks like just about everybody has voted. I'm going to go ahead and close the poll here. I'll give you another couple seconds. It looks like there's still some votes coming in. So click your answer on the screen. How often do you work with first-time home buyers? All right. Just about everybody has voted here, so let's close that out. Now, I'll share the results with you. So here's what you guys said. This is from our audience today. 2% of you work exclusively with first-time homebuyers. We would love to know what does that look like for you? Are you using down payment assistance programs? Do you have loan officers that are expert at those programs that set appropriate expectations and help you guide your clients through pre-qualification and so forth? Those are the things that we'll talk about later in terms of best practices and your partners in this process. But feel free to share that in the comments. Those of you that work, the majority of you that work frequently with first-time homebuyers, are you new to the business? Is it because there's so much demand? Do you enjoy it? Whatever you want to share. But nonetheless, we've got a lot of people here that are working frequently or exclusively with first-time homebuyers. There are some best practices to think about and to learn from them. And that's what we want to uncover here, because we suspect you're doing a lot of the things that we're going to talk about today. And those of you that don't work as often with first-time homebuyers, is it because you don't have those referral relationships in place? Is it because you don't have a loan officer that can help you with that first-time homebuyer business? Or maybe you've just been in the business and your book of business is mostly repeat buyers at this point. Nonetheless, let's get that off the screen and continue here so we can explore DPAs further. So we put out an index of essentially the down payment assistance data in our database each quarter, or at least a few times a year. This is essentially a big picture snapshot of everything that's out there. So there are, like I said earlier, about 2,500 programs nationwide, mostly down payment and closing costs, with a lot of tax credits, affordable first mortgages mixed in, and some other less common programs. Those come from about 1,300 housing agencies. So when you think about where these are available, everywhere. Every state has a state housing finance agency, and we'll look at some examples of where these programs come from. But every market is covered by something, and in many markets, there are all kinds of opportunities from the state, from nonprofits, from local governments, and so forth. And they all change constantly. Funding may come and go for some of these. Income limits can change, the assistance amount, the repayment terms, the purchase price limits. Any number of things can change without notice at any time. But we track all of those programs, and every month or as changes occur, we are updating those programs so that when you are using and relying on down payment resource to uncover these opportunities, you're seeing current, accurate information about those programs. And to give you some context, we made about 80,000, more than 80,000 changes to our database just in 1 year last year. So we're doing that work for you so you can take that information about DPAs to your clients and focus on solving their down payment concerns, their closing cost concerns, providing a value add, and so forth. Now, I said these are everywhere. Literally every market is covered. Every state has a state housing finance agency. There are municipalities, nonprofits, employers, foundations, housing authorities, community land trusts, and all manner of other organizations nationwide in your state, in your market, that are providing all manner of homebuyer programs, down payment help, closing costs, grants, silent seconds, soft seconds, and so forth, tax credits. Roughly 83% of all of those programs are funded, active, and available for you and your clients today. So our hope and our goal is that we can work with you to make more buyers, and really more renters and prospective buyers, aware of these programs and learn through you that they are out there, that you have a lender in place to help them, and that you can help them solve for the down payment option. Now, in terms of the mix of programs, I mentioned a moment ago, most of these are down payment and closing costs. Almost 3/4 of our database are programs for at closing, down payment help, or closing cost help. Those can come in many forms, and that's what we're going to really dig into today is get a little more expert at what these programs look like, particularly the three most common, which are the DPAs, 72% of our database, uh, mortgage credit certificates, 8% of our database, those are tax credits, and affordable first mortgages, which are higher LTV, low or no mortgage insurance, or otherwise affordable first mortgage options, sometimes with below market interest rates, often coupled with DPAs. So we'll dig into that. But just so you know, we track all of these, and most of them are down payment assistance. Now, I mentioned there's a state HFA in every state, and I covered a lot of these already. But just to reiterate the point, there are all kinds of agencies or providers or municipalities that are providing these programs funded in any number of ways through various HUD funding sources, through bond funding, through TBA funding, through employers, and more. But there's something in every market. There's a lot in most markets, and we want to uncover ways for you to talk about and find these programs and understand how they work. Now, they're all different in many ways, but there are some basic common requirements across all or most of these homebuyer programs. They are all or almost all for owner occupant buyers. So you can't go buy an investment property or a second home and use these down payment assistance programs. They all also offer some kind of minimum buyer investment. Now, sometimes that just refers to the first mortgage guidelines. So maybe that's 3.5% for FHA, 5%, 3%, 0% for conventional, depending on the mortgage. And then you've got VA and USDA as well. Um, but some of the programs have their own minimum cash investment. The other kind of investment that buyers are making when they utilize these programs is homebuyer education. Many of these programs require that the buyer go through typically a HUD certified, either in person or even online homebuyer education course where they learn about not just the home buying process or the closing process, but also long term successful home ownership and what that means and how to plan for that. So, we're big proponents of home buyer education, not just for its upfront value, but for the value long term for successful home owners. And then, of course, with all of these down payment assistance programs, these obviously aren't cash buyers, right? So they have to qualify for a first mortgage. In terms of properties, we did a study with Realty Track, which is now Adam Data, and this was a few years ago. But we looked at the all of the properties, not just listings, not just active listings, but all of the single family properties in all of the counties across the U.S. with 100,000 people or more. And we found that 87% of American homes in those counties, so all of the largest counties, medium-sized counties across the country, 87% of all homes, not just active listings, were eligible for assistance. Meaning, as those homes come to the market over time, as people move up and so forth, those homes, the locations are eligible for programs, which is important for a couple of reasons. Because one, location matters. Where you are purchasing a home determines which programs are even available or on the table for consideration. And then the price of that home is an important factor too, because many of these programs have maximum purchase price limits. So that means that 87% of those homes have programs available and their price or value at that time did not exceed the purchase price limits of those available programs, or at least there are some available. So we've covered a lot so far. We've covered how many programs are out there, some basic commonalities among those programs, the fact that properties are available as well. What we want to do now is dig into some of the nuances of the most common types of home ownership or home buyer programs. So first, we're going to dig into those DPAs, the down payment assistance programs, and talk about some of the variations and nuances there. Then we'll talk about affordable first mortgages, and then we'll get into mortgage credit certificates, which are those tax credits. Before we do that, though, let me ask another question. So in the last poll that I put on the screen, we determined that more than half of you are exclusively or frequently working with first-time homebuyers. Let me ask another question. How much money do you spend marketing to first-time homebuyers? So in a given year, are you spending dozens of dollars? Are you spending hundreds of dollars? Maybe you're spending thousands of dollars marketing specifically to first-time homebuyers. And this is really to get a feel for your, not just your commitment, but the level of effort and the spend and the prioritization of first-time homebuyers among our audience. And part of it is to show you that there are some ways without a lot of financial investment that you can educate more of these buyers and reach them with content and solutions and information. So go ahead and click your answer on the screen. You can just click the radio button next to your answer right there on the screen. I'll give you a few more seconds to do that, and then we'll share the results of this poll. All right, so it looks like most of you have voted here. Let me close this out and go ahead and share the results. So um, let's see, 14% of you are spending dozens of dollars annually to reach first-time homebuyers. A pretty significant portion of you are spending hundreds of dollars a year marketing to first-time homebuyers. Some of you even spending thousands of dollars a year marketing to homebuyers. Now that can mean a lot of things. Maybe it's your team, maybe it's you individually, maybe it's the brokerage. Nonetheless, what we want to start to uncover here is that there are some opportunities for you to reach these home buyers without a significant financial investment to either add value to the marketing you're already doing or to open up the opportunity to reach potential first-time home buyers by way of education and training and content. So we'll get into that here shortly. Let's get this off the screen. Now let's dive into DPAs in particular. So that is the most common type of homeownership program, that at closing down payment or closing cost assistance. This can come from any of those sources that we saw earlier, nonprofits, state housing finance agencies, employers, uh, cities, counties, land trusts, housing authorities, and so forth. And they can offer anywhere from a few $1,000s to tens of thousands of dollars, and in some high cost markets, kind of an outlier, but even a couple $100,000 in down payment assistance or closing cost help. A lot of them can be used for other purposes too. So prepaids sometimes can be covered. Repairs or rehabilitation of a property to bring it up to market, or to make accessibility improvements, things like that. So most of them are for down payment and or closing costs, but sometimes there are other eligible uses of those funds. Again, they all vary. I'll probably repeat that a few times because every program is different. Every funding source is different. Every market is different, and so forth. A lot of them do have a first-time homebuyer requirement as well, meaning that the buyer cannot have owned a home in the last 3 years. But it's important to recognize the misconception here as well, and to recognize the full scale of the opportunity. So it's not true that every DPA requires or is only available to first-time homebuyers. So I read the definition there of a first-time homebuyer. There are several different ways that's worded, depending on HUD, IRS, Fannie, Freddie, but all of them essentially point to the 3-year rule. You're a first-time home buyer for the most part if you have not owned a home in the last 3 years, and there are even exceptions there for certain family situations. So what that means is eligible buyers can be first-time home buyers, but also repeat buyers can be eligible for a lot of down payment assistance programs. Boomerang buyers, those that maybe experienced short sale or foreclosure, during the recession or thereafter, but have since repaired their credit and are trying to prepare themselves to get back into home ownership. So remember this, that 37% or more than a third of all of the DPAs we track do not have a first-time homebuyer requirement. That opens the door to all of those repeat buyers, move-up buyers, and so forth, so that they can be eligible for a lot of these programs as well. All right, now in terms of how these are repaid or how the assistance is offered, sometimes it's a grant, meaning it's forgiven at closing. There is no second lien, second mortgage. There is no repayment. It's a gift at closing. Sometimes they are forgivable loans. So there is a loan, there is a lien, but it is forgiven in some increment over some period of time, maybe 20% per year over 5 years. And as long as the buyer remains in that property as their primary home, then after that 5th year, the debt is wiped away and the lien is gone. Or maybe it's stay in the home for 10 years and the whole thing is wiped out after 10 years. Nonetheless, many of these DPAs are forgivable loans. Some of them defer payments. So maybe it's a 30-year loan, but they defer payments and you just repay it when you sell the home. So you don't add to the PITI or the housing payment by having that second loan, because they defer payments, and maybe it's forgivable, maybe it's payment kicks in at some point. Maybe it's just repaid when you sell the home and so forth. That's the affordability period, is over what time are payments deferred, and when is it forgivable. So you'll also hear second lien, silent second, soft second, subordinate loan, second mortgage. Those are all, they're not necessarily all the same term, but they're all synonymous in the sense that it's not a grant if it's a second lien or a subordinate loan and so forth. It means there is some sort of repayment term associated with that down payment assistance loan. And some may have a shared equity component. We won't get into too much detail about that, but there are a few DPAs out there that will offer an upfront investment to help you get into the home and then share in the equity growth over your tenure in the home. Now, eligibility requirements. Most of these programs have income limits. That means that they're looking, you have to be under that income threshold to qualify for the program. There can be a lot of nuances there. Sometimes it's based on total household income. Sometimes it's based on just the income of the applicants. It's important to know, though, especially if you're in a high cost market or anywhere really, but it's important to know that those income limits are quite often based on area median incomes. And it doesn't mean that it's always, low, moderate income. There are income limits out there that are 120, 140% of the area median income. We've seen up to 200%, and some just don't even have income limits, but that's a little less common. Nonetheless, the point there is, just like with sales price limits that we'll get to next, the income limits are often far more flexible than realtors and loan officers realize until they dig in and look at the program and start to understand the market opportunity with that program and the potential and larger audience that could be served by those programs. Same thing with sales price limits. They're market adjusted, just like income limits. They reflect the medians in that market and are thus higher. Income and purchase price limits are thus higher in higher cost markets and lower in lower cost markets, but still can be very flexible and surprisingly higher than one might think. Property location matters. We talked about that study we did earlier. That determines which programs are even on the table in that area. And then purchase price, of course, determines which properties are under the purchase price limits. FICO and credit, they matter. You still have to qualify for a first mortgage, but most of the time you won't see FICO scores allowed below 620, 640, 660, somewhere in that range. And again, each program is different, and sometimes it depends on the first mortgage. But nonetheless, that's kind of the floor for FICO when it comes to these down payment assistance programs. And of course, we talked about home ownership history. 2/3 of these programs have a first-time homebuyer requirement, but hundreds of them don't, and they're all over the country. And then things like military service, current or in the past, or reserve and guard, that can open the door to additional programs for those with a military background that may not be available to the general public. And of course, anybody in the military can still qualify for any program available to anybody else, right? Certain professions, especially first responders, educators, healthcare workers. In many markets, there are hero programs or first responder programs or teacher programs that, again, like those in the military, can open the door to more or additional or unique opportunities for those that work in those professions. Now, in terms of the advantages of down payment programs, I'll go through these a little quicker, but obviously you're lowering the LTV, the loan to value. You're lowering the loan, which means you're lowering the debt to income, which means it's easier for them to qualify. You're lowering their monthly payment on the house. That increases the purchasing power of their income, meaning they can potentially purchase more home or more readily purchase the home that they like because we've lowered the monthly payments with the down payment program. It can also mean that they can retain their savings. So what we don't want to see is people using their 401k to put a down payment, their 401k funds to put down money on a home, right? Sacrificing long-term investment for the opportunity to purchase a home. So retaining their savings means that these DPAs can be used to supplement cash to close, help with the down payment, keep them liquid when they move into the house, and enable them to be successful long-term homeowners, as we discussed earlier, as a byproduct of homebuyer education, so that they don't go into the home unable to, take care of a water heater that bursts or fix the roof and all of those things that we know come with home ownership. And then a little bit more on homebuyer education. We did discuss it is often required, typically from a HUD certified instructor or course, often in class or in person training. But increasingly, there are online options being made available to buyers so that they can perform and complete that course at their own pace, maybe faster than if they had to wait for an in-person class on a weekend or something. And I'll reiterate, it's not just preparing buyers for the purchase event, it's preparing owners for successful long-term home ownership. So again, we're huge believers in homebuyer education, but it's interesting to point out too that a lot of these classes, especially the in-person ones, um, are often pretty flexible when it comes to a realtor attending. It's a great idea to go to one of those classes, listen to the content, listen to the message, listen to the delivery, and take that to your marketing content, take that to your clients, and speak that same language to them. So that's DPAs. Now, next, I want to move into affordable first mortgages, and then we'll do tax credits. So we want to talk about what that means. We track these affordable first mortgages separate from the down payment assistance programs, but what does that mean? Now, before I do that, I'll put my last poll up on the screen. I want to ask one more question and get everybody's feedback and input here. Since we just finished the down payment part of this, the DPAs, tell us when you last used a down payment assistance program with a client. And again, you can click your answer on the screen. But when was the last time you had a client that closed on a home and used a down payment assistance program? Was it this month? We're mid-month in August. We're hearing, record years, record months from a lot of realtors, brokers, lenders, and so forth. Have you used a DPA this year? Has it been longer than that? Or have you never used one? And if so, is that, what's the reason for that? Is it because you don't have a lender that knows these programs or participates in these programs? Are you not working with first-time homebuyers often enough? Were you not aware that these programs were out there or so prevalent or could open so many doors? Those are just things to think about if you've not worked with a client who's used the DPA. But go ahead and click your answer on the screen. Just about everybody has voted, so I'll give you a couple more seconds here. Okay, so let's share the results of that poll. So 8% of you, that's good, that's great, we love to see that. 8% of you have used a DPA with a client this month, and we're only halfway through the month, right? We haven't hit month end, and it's middle of the summer, busy month. Even more of you have used or have worked with a client who used a down payment assistance program this year. For some of you, it's been a while. For a lot of you, it's never happened. So, I'll just harken back to those questions I was asking. If you haven't used or if you haven't worked with a client who used a down payment assistance program, I realize that can be a byproduct of a number of things. You don't work with first-time homebuyers often. Maybe you're new to the business. Maybe you didn't know about these programs. Maybe it's an issue with connecting with a trusted loan officer that participates in these programs and knows them well and can help you. Nonetheless, whatever it is, let's think about it. Let's think about solutions. And if you want to work with more first-time home buyers and carve out a growth strategy, then it's worth considering learning about a couple of DPAs, talking to some lenders that participate, and figure out what your strategy is for reaching, pre-qualifying, contracting, and closing those buyers. All right, so let's talk about affordable first mortgages. This is our second category of the most common homebuyer programs. The most common features are the potential for a reduced or below market interest rate. It expands the first mortgage options beyond just the standard market products because in particular, state and local housing finance agencies can offer very flexible low MI or no MI mortgage insurance options, below market rates, all kinds of flexibility and qualifying criteria to enable a buyer to more readily qualify for a mortgage and even access a DPA. So since they can be combined with DPAs and often the tax benefits of mortgage credit certificates, we track those as a separate category. so that you can become aware of those and inquire with your loan officer partners about the value, the benefits, the features of a particular mortgage or set of mortgage options. And then in terms of the advantages of those affordable first mortgages, obviously it reduces the buying cost because, as with the DPA, if you have lower or no mortgage insurance, then that's going to lower your monthly payments. Again, that's going to increase your purchasing power or the purchasing power of that borrower's income. And like with the DPA, it can also help expedite home ownership when you're reducing the buying costs and the monthly payments and the debt to income and so forth. All of that compounds to add purchasing power to that borrower's income, make home ownership happen faster, and make it more affordable. Now, mortgage credit certificates, we'll cover those last, and then we want to talk about some of the interesting nuances. We've hinted at things like teacher programs, veteran programs. There are some other ways to open new doors as well. Let's first cover tax credits. So this will be pretty quick, but essentially these are federal income tax credits, not a deduction. So what that means is you can get up to a $2,000 tax credit, which is a reduction of your tax bill, not a reduction of your taxable income. So it's a better tax credit is a better tax benefit than a deduction, generally speaking. You can use this every year if you get a mortgage certificate, which you have to get at closing. You can't go get one retroactively, but if it's offered in your market and you get that mortgage credit certificate prior to closing, then every year when you file your federal income taxes, you can take advantage of that tax credit, and you're essentially taking a percentage of the mortgage interest that you paid and getting a credit for that. The remaining interest can still be claimed as a deduction. So you don't lose out on the opportunity to deduct, but you get a credit for the first portion, 20%, 30% of the mortgage interest you paid. So it has life of loan value because you can use it every year, and offsets the mortgage interest cost by offering that credit back at the end of the year. The benefits are obviously reduced income tax liability, but in some cases, if you're getting a mortgage credit certificate, you can even recalculate income to increase qualifying income based on that tax savings. And also, some of them can be reissued through a refinance. So we mentioned it's a life of loan benefit, which means the loan that you got when you closed with the mortgage credit certificate. But some of those mortgage credit certificates can be reissued to that same borrower if they refinance out of that original mortgage, which means they prolong the benefit of the tax credit. So basically how it works is $200,000 home at a 4% interest rate, that's $8,000 in interest per year. If the mortgage credit certificate allows you to take a quarter of that interest and claim a credit, that's your max. The remaining interest gets claimed as a deduction still. So we won't go through any more complicated math than that, but that's essentially how it works. And they're great value adds for those that qualify because of the long-term life of loan benefit it provides. They're not getting anything at closing, right? But they are getting that long-term tax advantage. All right, now we've covered the three most common types of homebuyer programs. Now we want to get into some of the unique features and benefits. We've said that all of these programs vary; they're all different, and now we want to highlight some of those unique features and unique benefits. So, targeted areas. What does that mean? That means many programs, especially from state housing finance agencies, they will have increased benefits in targeted areas. So let's say, for example, a program is available statewide at certain income and purchase price limits. Well, in certain targeted areas, which could be zip codes or census tracts or neighborhoods, sometimes entire cities or entire counties, in those targeted areas, three things often occur. There's no first-time homebuyer requirement. There are higher income limits than the regular program, and there are higher sales price limits. Now, of course, it's limited to those targeted areas to get those additional benefits, but sometimes we even see more down payment dollars available to buyers that buy in those targeted areas. So that's important to know too. The program may be available statewide, but in those targeted areas, there may be more flexible income limits, more flexible purchase price limits, and that opens the door to yet more prospective buyers who could qualify. Now, targeted professions. We covered a lot of this earlier, but teachers, and let's clarify, that doesn't always even mean just a classroom teacher. And that's what I want to go through here is that, when you see a teacher program, remember that that may often mean faculty, staff, employees of the county school system or the ISD. So it's not always just limited to classroom teachers. In fact, most of the time we see with teacher programs, that's open to office staff, employees of the county school system, and far more than just the in-class K-12 teacher. We see pre-K, we see K-12, there are university programs. So when you see a teacher program, be aware of the fact that it may the definition of a qualified applicant may be someone who works in the education field, and that's defined differently for every program. But we show you what that qualified educator will be when you're using down payment resource. And then law enforcement, same thing. It doesn't always necessarily mean a police officer. In some cases, it does. Sometimes it's police or sheriff's deputy or corrections officer or employees of the police department. So again, the definition may be broader than the name implies if it's a police program. Same thing with firefighters, healthcare workers can be nurses, can be RNs, techs, any manner of healthcare worker. Again, depends on the program. And some municipalities have programs for municipal employees across any number or all departments. So they're all different. They'll all have different definitions of qualified applicants. But nonetheless, it's important to remember that for those targeted professions, usually the definition is broader than you may think. All right, so ask about their profession, ask where they work, obviously. Think about what that means in terms of eligibility for down payment programs. And remember that there are a lot of these programs out there, not necessarily in every market, but there are, at our last count, well over 100 programs with either incentives for those with the military background or that were unique to those with the military background. There were dozens of educator programs, dozens of protector programs, so law enforcement, firefighters, healthcare workers. So there are a lot of these programs out there for those in certain professions. If you know where they work, you could perhaps expand the opportunity to get down payment help. And we'll talk about layering here in a moment. But be mindful of profession and military background and the impact that can have on the kinds of down payment assistance programs that are available to them. And then with military and veterans, the most common benefit is a waiver of the first-time homebuyer requirement. Not every program for military or veterans does so, but it's very common for military or veterans not to have to be a first-time homebuyer to qualify for a program that the general public may have to be a first-time homebuyer for. And then, of course, they can be combined with VA loans. One common point that is made when we talk about VA loans is that they're 100% LTV, or can be if the VA is eligible. Well, that's great. No down payment, right? But what about closing costs? Or what about simply the value of having extra equity in the home by way of down payment assistance? That's a great value add and a great way to say thanks for your service. One example of a great program for veterans is the PenFed Foundation Dream Makers Grant. It is a grant. It's a 2-to-1 match. The match can be up to $5,000. So if the veteran puts in $2,500, they'll get another $5,000 as a match from the Dream Makers Grant program, and they can use that to cover closing costs or to put down on the home. Also remember, if your buyer is getting a down payment assistance program and can use some of that for closing costs, you don't have to go ask the seller to pay as much or anything in closing costs, and that can make your contract more attractive. So one drawback maybe we hear sometimes is that sellers don't like these. Sellers think it's going to delay the process. That's not often the case. However, it could also mean the seller gets a better contract offer from your buyer because they don't have to ask that seller for closing costs. Again, a great value add for veterans, but that applies to everybody. Now, how can we help you? So we gave you all this information. We know we gave you a lot of information, but how can we help you? What can you do with it? Who are your partners? Talk to your loan officers. They can help you understand the programs available in your market, at least the ones they participate in. Good to have 2 or 3 loan officers, at least one, of course, but maybe 2 or 3 that participate in various programs and can help you with first-time home buyers, help you carve out more of that business, you can always go to downpaymentresource.com and you can search there for the programs available in your market. If you are a member of the California Association of Realtors, you can go to downpayment.car.org and you can get access to additional marketing content. You can search for programs in your California market, and you can see even more detail about those programs when you find them. And you can also direct your clients to find downpayment.car.org, and they can perform a search themselves. And then if you are a member of any of these MLSs, you have access to our entire down payment resource suite of tools within your MLS. That includes down payment buttons on all eligible listings inside your MLS on both agent and client reports. So you'll see a little $ with a check mark on it on the listing pages or single line views inside your MLS. It looks different in each MLS, but that's what you're looking for. I'll show you an example in a moment. But if you're a member of one of these MLSs, you and your clients have access to information about these programs on all eligible listings. And again, 60, 70, 80% of your active inventory in most of these MLSs is eligible for programs. So you'll find that your clients are already seeing this information if you're a member of these MLSs, and they're engaging that link, and they're researching these programs. They want to know that there are solutions out there, and when they find out, they want to learn more. You also, as a member of these partner MLSs, have access to Down Payment Connect. I'll talk more about that in a moment, but it's a lead gen tool for you to go outside the MLS in your own personal marketing and engage consumers with these solutions, with this information, let them search for programs and connect back to you and only you directly. More on that in a moment. But this list, these are our MLS partners. You have access to all of that for free, no additional cost, as part of our partnership with each of these MLSs. This is what you're looking for if you are a member of those MLSs. You'll see a button like this on all eligible listings, active listings in your system. And when you see it, click it. We'll tell you what's there based on the location of that property and the list price of that property. So all of it is right at your fingertips. It's a click away when you're looking at listings or setting up a new client on an auto emailer, and they're going to see it too. So look for those buttons in your MLS system if you're a member of one of those MLSs that we showed you. And then lastly, I want to talk about Down Payment Connect for just a moment. Those of you who are members of our partner MLSs have this tool for free. Those of you who are not a member of one of those partner MLSs can subscribe to a paid version at downpaymentresource.com/DPC. It's super affordable, and you can go there and learn more, but I'll give you a quick overview. If you already have it or use it, then maybe you'll learn a little something here. If you haven't explored Down Payment Connect, then consider that as a very affordable, very attractive way to gain the attention of first-time homebuyers, educate them about these opportunities, and present them with solutions to their down payment problem. So what you get is your own landing page that we host where consumers can search for DPAs in your state or in your market, and they can see how many programs may be out there, but we don't give them detailed information about those programs until they fill out the contact form. That sends a lead to you and only you. There is no lead carousel here. Whether you're a member of our partner MLSs or you're subscribing to the paid version, you're getting your own leads when a consumer uses your form. And you can use that in social media. We see it on Facebook. We see it on Instagram. We're seeing it more on LinkedIn now. You can use it on your website. You can make a down payment section of your website. You can embed it into your website. We have an entire webinar dedicated to Down Payment Connect. That's available next month. But this tool gives you the opportunity to engage consumers and educate them about these DPAs and other homebuyer programs in your own digital marketing, where they're coming to your content, your resources, your website, engaging you on social media. And you can put this in front of them and say, hey, do a search, see what's out there for you, and they'll be connected directly back to you, and you can continue that conversation. So we encourage you to use it if you have it through your MLS, or to explore that if you don't. And then What about help? What about community? What about forums? Where do you go from here? How do I get creative ideas? With Down Payment Connect, you get access to all kinds of content, um, marketing ideas, but we also have a Facebook group curated by Tracy, our VP of Marketing, who's in the background here. And as of this summer, there are over 6,000 down payment insiders in this Facebook group. So you can go to the URL here and join this down payment insiders group of realtors and other practitioners around the country that are using Down Payment Connect. They are working with first time home buyers. They have clients who use DPAs. They have loan officer partners who work very well with them to pre qualify and close clients with a DPA. They share marketing ideas, best practices, success stories. They're all over the country sharing how it's working for them, for their brokerage, in their market, given their constraints on inventory, price, and so forth. So we encourage you to join that group. You don't have to do anything but go to that URL and request to join, and then become a part of this our movement here to try to bring more awareness of these programs to you guys, to loan officers, to consumers, and so forth. So with that, if you have any questions after the webinar, you can reach out to us at info@downpaymentresource.com. And if you're curious and want to do a little bit more research, you can go to downpaymentresource.com/reports. And we've got all kinds of interesting information and data and so forth that you can review to learn a little bit more about DPAs and about what we do and trends in the affordable lending and affordable housing sector and so forth. So with that, thank you very much. And we hope that this was helpful for you. And we will get into Q&A here in just a moment.